We're very pleased to be here to discuss today's monetary policy decision. Today, the Governing Council maintained the policy rate at 2.25%, and we've held the policy rate at this level since October. L'économie canadienne reste confrontée à l'incertitude élevée liée à la politique commerciale américaine et les risques géopolitiques. La guerre en Iran vient ajouter une nouvelle couche d'incertitude. Son impact sur les économies mondiales et canadiennes va dépendre de la durée du conflit et de la mesure dans laquelle il va s'entendre ailleurs au Moyen-Orient. L'inflation au Canada est proche de la cible de 2% depuis plus d'un an. Mais comme on le voit, la guerre en Iran fait bondir les prix de pétrole, ce qui va créer de l'inflation à court terme. L'économie canadienne connaît déjà de nombreux défis. Il y a maintenant plus de volatilité. Le rôle de la Banque du Canada est d'être une source de stabilité. Nous soutenons l'activité économique tout en nous assurant que la montée des prix de l'énergie ne se transforme pas en inflation persistante. The Canadian economy continues to face heightened uncertainty related to U.S. trade policy and geopolitical risks. Now the war in Iran has added a new layer of uncertainty. Its impact on the global and Canadian economies will depend on how long the conflict lasts and the extent to which it spreads across the Middle East. Inflation in Canada has been close to the 2% target for more than a year now. But as we've seen, the war in Iran is causing oil prices to move sharply higher, and this will push inflation up in the near term. Canada's economy is dealing with a lot, and we now face more volatility. The Bank of Canada's role is to be a source of stability. We're supporting economic activity while ensuring that a jump in energy prices doesn't turn into persistent inflation. So let me expand on what we've seen in the economy since we published our January monetary policy report and what we see ahead. Recent data show the Canadian economy remains in excess supply and is growing slowly as it adjusts to U.S. tariffs and uncertainty. After growing 2.4% in the third quarter of last year, GDP shrank by 0.6% in the fourth quarter. This was weaker than we forecast at the time of the January MPR, but that's mainly because inventories were drawn down more than we expected. Domestic demand actually grew by 2.4% because of the strength in consumer and government spending, although housing was weak. Data received for early 2026 suggests the economy is expanding again, but at a slower pace than we had forecast in January. The labor market remains soft. The job gains we saw late last year were largely reversed in the first 2 months of 2026, and the unemployment rate rose to 6.7% in February. Recent trade data have been volatile, but they suggest growing weakness in exports. Inflation eased further to 1.8% in February, down from 2.3% in January. CPI inflation, excluding taxes, and measures of core inflation have also come down and are all now close to 2%. Food inflation, however, remains a problem. Food inflation slowed in February, but is still elevated. The recent sharp increase in global energy prices is causing higher prices at the pump, as we've all seen, and this will push inflation up in coming months. It's still too early to assess the impact of the war on growth in Canada. If higher oil prices are maintained, this will boost incomes from our energy exports. At the same time, higher oil prices squeeze consumers, leaving them with less income for everything else. Beyond the jump in energy prices, the war in Iran will affect households and businesses in other ways. Financial conditions have already tightened. Global bond yields are higher, stock markets are lower, and credit spreads are wider. Transportation bottlenecks caused by the effective closure of the Strait of Hormuz could also impact the supplies of other commodities, like fertilizer. In its monetary policy deliberations, Governing Council is considering both the most likely path for the economy and inflation and the risks to the outlook. Uncertainty is acute. Trade and geopolitical uncertainties remain, and the conflict in the Middle East has broadened the range of possible outcomes. Relative to our January forecasts, risks to economic growth are tilted to the downside. Near-term growth looks weaker than expected, and the review of the Canada-United States-Mexico agreement is still a big unknown. At the same time, risks to inflation are tilted to the upside because of the sharp increase in energy prices. Economic weakness combined with rising inflation is a dilemma for central banks. Increasing interest rates to slow inflation could further weaken the economy. Easing interest rates to support growth risks pushing inflation well above target. Canada's outlook is further complicated by structural change, shifting trade relationships, the adoption of AI, and changes in demographics. With inflation close to target and the economy in excess supply, the risk that higher energy prices quickly spread to the prices of other goods and services looks contained. But the longer the conflict lasts and the wider it gets, the bigger the risks. Governing Council will look through the war's immediate impact on inflation. But if energy prices stay high, we will not let their effects broaden and become persistent inflation. À notre réunion cette semaine, on a décidé de maintenir le taux directeur à 2,25%. On reste prêt à réagir si les perspectives changent. On continue d'évaluer l'impact des droits de douane américaines et de l'incertitude liée aux politiques commerciales. On regarde aussi comment l'économie canadienne s'ajuste et on surveille de près le conflit au Moyen-Orient. At our meeting this week, we decided to maintain the policy rate at 2.25%. As the outlook evolves, we stand ready to respond as needed. We are continuing to assess the impact of U.S. tariffs and trade policy uncertainty and how the Canadian economy is adjusting. And we are closely monitoring the unfolding conflict in the Middle East. The bank is committed to ensuring that Canadians continue to have confidence in price stability through this period of upheaval. And with that, the Senior Deputy Governor and I will be very pleased to take your questions.
Okay, thank you, Governor. We will go to questions now. We'll start with the reporters who are here in Ottawa at the bank, and then we'll go to those who joined remotely. As usual, I'm asking everyone to limit yourself to one question, please. That way we will have a chance to get to every media outlet. If I forget to do so, please state your name and affiliation. For those in the room, please activate the microphone by pressing the button in front of you so that everyone can hear your question, and press it again to turn it off once you're done. Avant de poser votre question, veuillez vous identifier si je ne l'ai pas fait, et comme d'habitude, libre à vous de poser vos questions dans la langue officielle de votre choix. So we will start with our first question. I'm going to take questions on this side of the room as I'm looking at it, and I'll start with Mark Rendell of the Globe and Mail, please.
Hi, Governor. Mark Rendell with the Globe and Mail. You spoke about how it's too early to tell whether the Middle East is going to be, like what the impact on the Canadian economy is going to be. I'm wondering, in general, is a oil price increase like this net positive or net negative for the Canadian economy? And if there's kind of a question of duration, like it's a short-term shock to consumers, but a longer-term potential benefit to oil producers and oil-producing regions, like how long does that duration need to happen before it shifts from net negative to net positive?
So, yes, there are multiple effects of higher oil prices on the Canadian economy. And as you suggest, it depends very importantly on the duration. So, I checked the screen before I came down. WTI was $98, $99. So, if oil prices stay high for an extended period, that does mean that the income coming into the country from our exports of oil, we are a net exporter of oil and natural gas, those incomes will be higher. That will tend to support the economy. The other side, of course, is that for consumers, for most businesses, most other businesses, higher oil prices are going to squeeze them. They're going to for households, if you're spending more to fill up your car, you got less money to spend on everything else. That'll tend to hurt consumption, and for businesses, they're getting, their profit margins can get squeezed as they have higher energy costs. There are also some other effects, though. As I mentioned, since the start of the war, you've seen some tightening in financial conditions. Stock market's down, bond yields are up, credit spreads have tightened. So, that's also impacting Canadians. And then, I think the longer this conflict goes on, there is more potential for wider implications. Oil and natural gas are not the only commodities that go through the Strait of Hormuz. Other petrochemical commodities, fertilizers in particular, go through. If they're blocked, that will have other global impacts. So, all to say, I think the short answer, look, is it's too early to assess the effect on growth. It's going to depend on, it is going to depend importantly on duration, and it's going to depend on sort of how this conflict materializes. I think, I think what we can say is that certainly if it lasts, it's whether it's net positive or net negative, I think you will see some shifts in the composition of growth. Obviously, the energy sector will do better. Consumers will be more squeezed.
Okay, we'll go to Craig Lord from the Canadian Press, please.
Hi, Governors. Thanks for taking our questions. How is the Bank of Canada thinking about food inflation right now? Are impacts there, in your view, mostly transitory compared to exchange rates and the upcoming energy price influence, or is it becoming a more persistent problem in the wider inflation basket?
Yeah, we have been looking at this closely. I'll ask Carolyn to say a few words on this.
Yeah, I mean, the governor mentioned this in his opening remarks. I mean, we're starting from a position where food inflation continues to outpace headline inflation a bit. It's certainly adding to that sense of affordability that Canadians are feeling. Energy shocks can affect food prices. And again, it comes back to the previous question. It depends a lot on duration. We import a lot of our fresh foods, so transportation costs add to food costs. There's inputs to fertilizer costs that are being affected by the war in Iran. So that if that persists, that could have a longer term effect on food inflation too. So again, we're back to it's a bit early to tell what the effects on food inflation will be, but certainly energy is a big input cost to food.
All right, we'll go to Greg Quinn from Market News, please.
Good morning. The statements use the word dilemma to describe the risks of economic growth and faster inflation. That sort of implies a balanced approach, but you also have new language about higher energy prices and a lack of tolerance for that becoming sticky inflation. So is this really a situation where your view of policy moves is equally balanced, or do you have the thumb on the scale towards a potential increase?
Look, I think the short answer, Greg, is uncertainty is high. Since we published our forecast in January, we've seen some evolution of the risks, as I outlined. We're going to be seeing how those evolve, how those materialize, and we're prepared to respond as needed. I think there are really two main things we're watching. Obviously, the war in Iran. We're in week 3. This is an economic shock. How big it is going to depend a lot on how long it lasts, whether it widens, how disruptive it is. Here in Canada, we are starting from a position where inflation is 2%. It's actually been close to 2% for more than a year. Our measures of core have been decelerating, and the economy is in excess supply. So, what that tells us is that the risk that higher energy prices are going to quickly spread to other goods and services, that looks contained. That doesn't look too high. So we've got some time, so it made sense to hold today. We know inflation is going to go up in the near term. We've all filled up our gas. We've all filled up our car. We've seen the prices at the pump. That's going to show up in March CPI. The issue for us is not really the immediate increase in inflation. We know that's going to happen. It's does that start to get generalized, start to spread, start to look more persistent? That's certainly what we're going to be looking for closely. The other thing, though, we're continuing to look at and assess is the impact of higher tariffs on the economy, the impact of trade uncertainty, the structural change that the Canadian economy is going through. Higher tariffs have weakened the Canadian economy. That will put some downward pressure on inflation. So, we've got to look at the whole situation. We've got to look at how the risks evolve, and we'll take it one meeting at a time.
Okay, we'll stay over here on this side of the room. Mackenzie Gray, please, from Global.
Hi there. In this dilemma with the potential inflation risks in Iran and, of course, the outstanding issues we've seen around trade with the U.S., what do you view as the biggest risk between those two issues to the Canadian economy right now?
Well, look, as I said, I think we've got to look at the whole situation of the economy, and growth and inflation are related. There are also additional cost shocks coming through energy prices. So I don't think it's a matter of sort of saying one thing is bigger than the other. You got to look at the whole thing together. I'm not sure I can be much clearer than that.
Okay, and over here, Annie Bergeron-Oliver, please, from CTV.
Hi, Governor. You sort of touched on this, but you mentioned that the longer the conflict goes on, the wider it gets, the bigger the risks are. I'm wondering if you can talk a little bit about what those wider implications are on the economy, what you're most concerned about, and how concerned consumers should be about inflation over the coming months.
Well, look, the first thing I want to say is that, the biggest cost of the war in Iran is a human tragedy, but it's also an economic shock. And the fact, in particular, the fact that the Strait of Hormuz is essentially closed is cutting off a significant amount of global supply of energy. In Canada, that's not affecting us very directly, but when there's less supply globally, prices are higher globally. And you've seen a sharp increase in the global price of oil. Brent's over $100. As I mentioned, WTI was about $98, $99 when I came down. The impact that will have on economies is going to depend a lot on how long it lasts. And as I mentioned, energy is not the only thing that's going through the Strait of Hormuz. So, in the short run, people have, companies have inventories, countries have inventories. They can manage, but the longer it goes, those inventories get depleted, and that shortage really starts to bite. And that's when the economic consequences start to become more, bite more. As the effects elevate, I think you'd expect to see more impact in financial markets. So the longer it goes, the bigger those effects are likely to be. As I said, for Canada on the growth side, there's a variety of effects. We're a net exporter of energy. We're a net exporter of fertilizer. Higher prices means more income coming into the country, but for consumers or any business buying those products, those costs are up. They're getting squeezed. So, and then look, on inflation, the impacts in the near term are pretty clear. When we get the March CPI report, it's going to show inflation's higher. The issue for us, though, is not really about the near term. I realize that's going to impact Canadians. Unfortunately, there's nothing we can we can't fix the war. What we can do, though, and what we will do, is what we will ensure that if energy prices stay high, that does not become ongoing, generalized, persistent inflation.
Okay, let's go to the far side of the room now, and I'll call on Kevin Carmichael from The Logic, please.
Good morning. The bank's been doing a lot of work on supply shocks since the pandemic. I wondered if you could talk us through how you're applying some of the work that you've been doing to the situation we're in now.
Well, I mean, maybe, Kevin, I could say a few words about the things we're watching, and I'll ask Carolyn in a minute to say a few words about how we're doing that. As I've highlighted, there are really two main developments. Obviously, the new development is the war in Iran, and as I've stressed, inflation's going to go up in the near term. What we're focused on is, we need to guard against that spreading to other goods and services and becoming persistent inflation. So what sort of things will we be watching? Well, like obviously you look at the total CPI, that's our target. Does that initial increase look like it's persisting? Core measures of inflation are very helpful. The core measures will tend to strip out volatile components, like energy. So they'll give you an idea of what's happening to everything else. Is it spreading? If you start to see core moving up a lot, that's a sign that it's spreading. We can also look at the whole distribution of price changes. Is it just a few components of the CPI that are driving inflation up, or is it many components? The more components, the more worried we'll be getting. And importantly, we'll be looking at inflation expectations. The other thing, which we've been assessing for some time, is the impact of tariffs on the economy. And there, we're looking at how much slack is in the economy, what's happening to employment, what are business investment and hiring intentions, how, are we seeing spillovers from the hard-hit sectors to the rest of the economy? And then ultimately, how is that impacting inflation? If that is weakening the economy, how much downward pressure is that putting on inflation? So we will be using models, and we have been developing models with more sectoral detail, and that's very helpful when you've got a shock that's going to have very different sectoral impacts. We'll also be using various data sources. Why don't you say a few words about how we're actually going to do that?
Yeah, I'll do that right away. I want to just add to what the governor's said too, Kevin, is one of the things, we're getting better at assessing supply shocks for sure. And our colleague, Deputy Governor Kazicki, recently gave a speech that kind of elaborated on our thinking there. But one really important thing to keep in mind is what's the starting point when you go into a supply shock. When we went into the supply shock coming out of the pandemic, the economy was overheated. That made it easy for prices to get passed on, price increases to get passed on that were coming from a supply shock. We're not in that same situation now, so that's something we have our mind on too. What's our starting point going into the supply shock? To come back to the other point, this is an environment where we put a real high price on really high frequency data and near-term data, and on things like our surveys and our outreach. So we get out into the economy and we talk to businesses to understand what they're seeing and how they're reacting to supply constraints. I'm going to spend all of next week in Manitoba. One of my colleagues was just in Fredericton. We've got trips planned across Canada. That helps us a lot to get out there and talk to businesses. So that's one of the things we'll be doing. And then we've gotten better at using high frequency data too. So bringing in micro data on price adjustments and that sort of thing. So that'll help us detect this potential for prices to move from energy into other goods and services faster, and we'll be able to react faster.
All right, next I'll call on Pramit Mukherjee from Thomson Reuters.
Good morning, Governor. In the opening statement, you have said that you will look to the war's immediate impact. can you tell us how long will this immediate be? 2 weeks from now, 3 more weeks, or 6 weeks when we reach your April 29 decision?
Well, I don't think you measure this in weeks. I think, we get CPI data monthly. Most of our data comes monthly. So, we're not looking at this in terms of weeks. As Carolyn just underlined, we're starting in a situation where inflation is close to target, core measures have been decelerating, there's excess supply in the economy. So we've got some time to assess. We don't think, against that background, we don't think we're going to see rapid pass-through of higher energy prices into broader prices of, broad goods and services prices. So we've got some time to make that assessment, and we've just outlined the things that we'll be looking at. And as I underlined, you got to look at the situation of the whole economy. Obviously, we're going to be looking at developments in Iran. How long does this conflict go? How disruptive is it? How high what happens to energy prices? How high do they stay for how long? That's not the only thing going on in the economy. We're facing higher tariffs. There's still a lot of trade uncertainty. We'll be assessing that part as well. Looking forward, I don't think I can say it any clearer. As those risks evolve, as the economy plays out, we're prepared to respond as needed. What does that mean? Well, yes, we could keep holding the interest rate where we are, but look, if energy prices stay high and we start to see evidence that it is generalizing and becoming more persistent, we can raise the policy interest rate to cool inflation. On the other hand, if energy prices come back down, we see weakness in the economy. We see more weakness in the economy. We can lower our policy rate to add more support. I think the message is there's a lot of uncertainty there. We'll be following those developments carefully, and we'll respond as needed.
All right, I've got a couple more on the list here in Ottawa. Let's now go to Paul Vieira from the Wall Street Journal, please.
Good morning, Governor. Do you think officials would have talked about more accommodative rate policy to address weakening economic conditions were it not for the war in Iran?
It'd be great to talk about a different economy than the one we're actually facing. But, as I said, we need to look at the whole situation. Certainly, as we've highlighted, since we published our January report, the employment, we've seen declines. We've seen more job losses. It's really largely reversed the job gains we saw through the fall. There's a lot of volatility in the export data, so you gotta sort of look through the noise. But exports look, even looking through the noise, exports look soft. The housing market remains weak. So, when we look at the data today compared to what we forecast for Q1 growth back in January, it looks like it's going to come in lower than what we previously forecast. So the risks are tilted to the downside on growth. I think, to get to your question, looking forward, we don't have much data yet for this year. We're just starting to get it. We would be looking at, well, how is that risk materializing? And yes, if it was materializing further and we didn't have inflationary pressures, I expect we would be talking about lower rates. But we're operating a world where there's more than one thing going on. We're now facing increased inflation risks, and those two things go in opposite directions for monetary policy.
And we'll wrap up here with Eric Hertzberg from Bloomberg, please.
Hey, good morning. Gasoline correlates pretty strongly with inflation expectations. And the inflation spike of 2022, it's not really a distant memory. Neither are the bank's hikes at that point. How worried are you about the spike in oil prices pushing Canadians' inflation expectations higher? And to pile on Greg's question, how would the bank respond if inflation pressures are sustained and growth remains weak?
Well, I mean, we saw the biggest increase in inflation we've seen in the last 40 years, a couple of years ago. I guess a little more than a couple now. And what we saw then is that households' near-term inflation expectations did go up with actual inflation. Fortunately, their longer-term expectations remained well anchored. And that actually was very important in allowing us to get inflation back down relatively quickly without causing a recession. We do focus a lot on longer-term inflation expectations because if those do become unhinged, it becomes much harder to get inflation back down. That's what happened in the 70s. Unfortunately, the world was hit with a couple of big energy price shocks. Monetary policy was inadequate, and so we had a decade of high inflation, and that caused inflation expectations to shift up, and that made it very hard to get inflation back down. That's exactly what we want to avoid. We are prepared to look through the immediate impacts of higher energy prices on inflation, but we are not going to allow that to spill over and become persistent inflation.
Okay, that's it for Ottawa. We will now go to those reporters who joined us remotely. I'll just remind you, folks on the line, please come off mute only to ask your question, then go back on mute as soon as you finish so everyone can hear the response. Let us start with Barbara Schechter from the Financial Post, please, followed by John McFarland of Yahoo Finance.
Hello, thank you for taking the question. I just wanted to ask about sort of the going back to the pandemic, which you were just touching on, and sort of ascertaining when to move, because there was a lot of criticism at that time. How do you know when to make the move to if things are bleeding out and they're going to be more persistent? How can you sort of assure Canadians that you know this time when to make that move? And sort of as a follow on to that, we've heard a lot of commentary about how it's not cut and dried. Sometimes you may have to move in a direction that seems to be counter to what you would normally do. Things are different. There's structural change. So if you can address that in the question as well, how do you know when you're making the move at the right time, and what is that move? It seems less clear than it's ever been.
Well, I think I'd start with something Carolyn just emphasized. There are some very important differences from the situation we are in today than the situation we were in coming out of the pandemic. Coming out of the pandemic, there was huge pent-up. I mean, we all remember we couldn't buy many of the things we could, especially services that we couldn't. Things were closed. We couldn't get them. Coming out of the pandemic, there was huge pent-up demand. People also had a lot of accumulated savings because they hadn't been traveling, they hadn't been going to restaurants. There was huge pent-up demand. So, as the virus faded and we all got vaccinated, life got back to normal. There was a huge surge in demand. Supply was still disrupted. It couldn't keep up. And then on top of that, Russia attacks Ukraine and drives global energy prices higher. So that came against a background when inflation was already above target, the economy was overheated, and there was considerable pent-up inflationary pressure. This energy price shock, first of all, we'll have to see how long it lasts, how persistent it is, how big it is. But the other thing I would emphasize is it is coming against a background of an economy where inflation, we've been close to 2% inflation for more than a year now, about a year and a half. We've been within the 1 to 3% target for 2 years. the latest reading on CPI inflation is 1.8%. Our core measures have been decelerating. So there isn't a lot of sort of pent-up inflationary pressure in the economy. So against that background, we don't think this is going to spread quickly. So we've got some time. But, as I've highlighted, if energy prices stay high, particularly if they go even higher, yes, that does increase the risks. And what we can't do is let that become persistent inflation. So I can't put that on a calendar. It's going to depend on what happens with the war in Iran. It's going to depend on what happens with energy prices. What I can say is, I think we've outlined clearly the things that we will be following to make those judgments. And we will be updating you, at each meeting on what we see there.
The other thing maybe I'll add is just back to Kevin's question about getting, we've had a lot of practice really in looking at supply shocks more recently, so getting better at assessing them. And we've talked a lot about how the duration and whether or not this conflict in Iran spreads will have a big impact. So if you think of the Strait of Hormuz, that could get reopened. If things are resolved quickly, the strait reopens and oil and other commodities start moving, that'll be a quick bounce back. But as we see infrastructure damage in the region, that will take longer to remedy too. So we know that some of the supply can come back quickly, but not all of it. So things like that will matter as well.
All right, next is John McFarland from Yahoo Finance, please.
Hi, thanks so much for taking our questions. So it's understood that higher oil prices will benefit energy producing regions in Canada especially, but we've also got manufacturing regions suffering and economists saying housing markets in some of the largest cities in Canada, which are outside of the energy producing regions, are possibly in recession. Highest level of mortgage arrears since 2012 in Ontario, with mortgage renewals, a wave of them with rates looking like they're going to go higher. So how is Governing Council thinking about setting a single policy rate given increasingly divergent regional conditions?
Look, you're right. When energy prices change, when you get sectoral tariffs, these have very different effects on different industries. And those industries tend to be regionally concentrated across the country. So yes, some communities will be certainly harder hit than others. Some will even benefit from higher oil prices. That's not something we can address with monetary policy. And we've got to look at the situation in the whole economy. We have one target, and that is inflation for the whole country. What you do see over time is that inflation across different regions of the country tends to be pretty similar. It's not every month exactly the same, but if you average over a year or two, inflation in any province is pretty similar over time to the national average. Our job is somewhat limited. It is to keep inflation low and stable for the country. That will, if you do it on a national basis, it will work for the country as a whole. That will be our inflation target, is our ultimate beacon.
Okay, next I'm going to call on Anastasia Blosser from the Toronto Star, please, followed by Rob McClister. Anastasia?
Good morning. Thank you for taking our questions. With official CPI data arriving with a lag, but active conflict in Iran potentially feeding into inflation, what high-frequency indicators is the Bank of Canada relying on to gauge what the economy could be facing in real time?
Well, the governor talked just a few minutes ago about the different measures we have of inflation that trim out certain prices that we know are more or less volatile under different shock scenarios. So certainly we use a variety of different inflation indicators. Some of the high frequency data, I mean, we can do some of the same things Canadians do. We can look at websites and we can get data from businesses. We know businesses are adjusting their prices more frequently than they used to. We have access to some larger data sets from Stats Canada that give us pricing information too. And then, as I said earlier, we also put a big premium on just talking to businesses and talking to Canadians, our surveys, our outreach. We invite different sectors of the economy in to meet with Governing Council to give us real-time feedback and information about what they're seeing in the economy.
All right, next we'll go to Rob McClister from Mortgage Logic News, please.
Good morning. With war and tariffs, housing weakness might seem less of an urgency. But this month was the first in 27 years that average home prices fell over a 5-year span. So how much does that worry you? And if average home prices dropped another 10% or so, do you have a sense for how much that could weigh on inflation?
I mean, you're right, Rob. The housing market is looking weaker and weaker than we had incorporated into our January outlook. But so that's something we'll be looking at certainly when we prepare the April outlook. As you would know, I'm sure some of the more recent data coming out in early March looks like we might see a bit of a rebound, but it's probably too early to tell. So definitely we need to take another look at the housing market. What I would say about prices is, I think I said this at the last press conference, we need house prices to come down so that housing is more affordable. We've all been worried about how fast house prices went up in recent years, and now we're worried about how they're coming down. We do need them to settle down a bit for housing to get more affordable. There isn't really a path to affordability, particularly in some of our big centers, without house prices correcting a bit. So we will watch that. Housing is one of the things that feeds into our forecast and our deliberations on monetary policy.
Okay, and we just have time to wrap up with Max Sato from Mace News. Go ahead, please, Max.
Thanks. Thanks, Paul. Good morning, Governor. I understand you're ready to act either way, but let me try this. You seem to be emphasizing the upside risk to inflation just a tiny bit, and Canada is a net energy exporter, so maybe in a better position than some other major economies like China and Japan. And for example, Bank of Japan would be concerned about the downside risk to inflation if energy costs hurt spending and overall growth, which should obviously lead inflation expectation to actual inflation lower, although they've seen a worse combination of a spike in prices and weaker growth in 73, 79, 88, 88 Iran-Iraq war. But looking at Canada, that sort of risk seems to be relatively lower. What's your take on this?
Well, my take is there's nowhere I'd rather be than Canada. Look, for really every country in the world, higher oil prices means higher inflation in the near term. But, not every country is affected the same. Particularly, the North American natural gas price is lower than the European, for example. So, Europe will tend to be hit harder by higher natural gas prices. For Europe, the marginal producer is Qatar, and shutdowns there are having a big impact on the price of natural gas in the continent. They are more linked than they used to be because we've got more LNG, but there's still, certainly for Canada, the impact on natural gas is less. On growth too, the impacts depend whether you're an energy importer or an energy exporter. If you're a big energy importer, not only are you facing higher prices, you've got more income leaving your country to pay for higher energy prices. In Canada's case, we are a net energy exporter, so we've got more income coming into the country. One consequence of that is our currency has been more stable than many other countries. So it's not really appreciating to buffer the increase in higher oil prices, but it's not, many of these oil importing countries are seeing their currencies depreciating, adding to the inflationary impact. So, yes, everybody in the world is affected by this, but depending on the structure of your economy, your geography, the effects will be somewhat different. Canada is certainly going to be affected, but yes, we, relative to some other countries, we are in a pretty good position.
And that will conclude today's press conference. We all hope the last press conference of winter. Thank you, Governor and Senior Deputy Governor Macklem. Thanks, everybody, for being here today.
Thank you all.
Thank you.